Welcome to Wealth Matters Podcast. I have with me Stanton, and he's the first guest who I have invited repeatedly, right? So he's here second time. He's one of my favorite financial advisor, and he has been doing this since 2011. He has been focusing on full service financial service and investment advisory firm he's with. Hey, welcome, Steven.
Hey, thank you, Alpesh. It's great to be back. I know we enjoyed our first conversation through the podcast, and it's great to see your success with the podcast itself, and just glad that you invited me back.
Thank you. So, Steven, tell us something interesting about yourself.
Interesting about myself. I always hate these questions. We are a full financial advisory firm here. That's probably not as interesting. But we are located over in the San Ramon area, right off of 680. And, as you know, I'm a workout enthusiast as well. That's
of
where
course.
that was actually at 24-Hour Fitness many years ago. And since, the crazy times of what's going on with the coronavirus and things like that, the gyms aren't open. So I actually went out and got a home gym workout, which was, I was very skeptical at first. It's a band workout. So,
okay.
Especially men, when they hear band workouts, they think, that's not going to be strong enough for me, or,
right.
build the muscle that I want to build. But surprisingly, I found some extremely strong bands and really been enjoying the working out at home, and actually able to work out outside, which has been a lot of fun. So
that's a lot of fun for sure. So we need to catch up on that then.
Yes, for sure. Anytime.
Hey, so we want to talk about this strategy you were mentioning to me, applying leverage to life insurance policy. And I want to dig deep into it. How does this strategy work?
Yeah, so this strategy is really designed to help people increase retirement income, and not just increase it a little. I'm talking, potentially increase it 60 to 100%.
Oh, wow.
Yeah. It's a pretty phenomenal program that's been put together, and really, how I kind of explain it to people and try to have them understand it. If you think about it, it's similar to, let's say a company match. If you work for a company, you contribute to your 401k. The company's going to match you some type of percentage.
Right.
So, however, instead of traditional matching, which is a small match anyways, we actually use lenders to match the money. So what ends up happening is that you end up committing to putting money away for a 5-year period. Let's say if you put in, let's say over those 5 years, you end up putting $200,000 into this type of strategy.
Mm-hmm.
The lender is going to match you on average about 3 times that amount.
Oh, okay. So is this similar to like what's called premium financing strategy?
It is similar to premium financing. It is premium financing in a way. It's just structured a little differently.
Okay.
And the way it's structured is that it's been able to open this up to a lot more individuals, where traditional premium financing, only the wealthy were able to access that.
I see.
So how this works is that, a person would put in, let's say, $200,000 over 5 years. It could be less, it could be more, just depending on the person's situation.
Mm-hmm.
And the bank's going to match you about 3 times that amount. So let's just say $600,000 over a 10-year period.
Oh, wow. Okay.
Yeah. So over a 10-year period, now you have $800,000, 200,000 of yours, 600,000, which is the bank money, going into this policy that is now going to be growing on a compounded interest rate for your benefit for retirement. Also, one of the big benefits about this strategy that's different than traditional premium financing is that the lender is fully secured by the cash value that's in the policy. So what that means is that there's no personal guarantees and any loan docs that a client would need to sign. So they don't take on any liability on financing with this strategy, which is a huge benefit. And
that sounds awesome.
yeah. And then, and then down the road, once a lender's paid off, you have access to the funds via policy loans to provide supplemental income and other living benefits within the policy itself. So ultimately, this strategy helps you purchase more life insurance benefit than you would normally be able to on your own, and only requires you to contribute for 5 years, unlike a lot of the other policies out there where you have to pay premiums for the rest of your life.
So
Yes.
that's an important thing to know. So I only have to sign up to send the premiums in for first 5 years. That's it. And once I've
Correct.
paid
Correct.
that,
Yep.
I am done. I don't need to cancel the policy. I just need to keep the policy active, and the bank takes over or the lender takes over.
Exactly. Exactly. You're just committing to putting in 5 payments or 5 annual payments,
Okay.
and then after that, you don't have to put anything else in. One of the other great things about this strategy, I'll just mention as a side note, is that we actually structure this to be owned by a trust. And
Okay.
what that does is also helps give you asset protection. So God forbid if you ever get sued, things like that, this part of your assets has been protected because it's structured in a trust that's based out of a Nevada-based trust.
Oh, I
So
see.
we really helped think through this on how to protect the assets, but also ultimately grow your retirement income and provide 60 to 100% more of retirement income.
So I thought, and I don't want to go on a tangent, but I thought that all the life insurance, whole life or IULs, they are fully asset protected. Is that not true?
So that is a misconception. It really depends on the state itself. So
Oh,
every
okay.
state has different levels of asset protection when it comes to life insurance, annuities, and even your home. So some will protect it up to 100%. Some have no protection, and some have
Oh,
up to a certain dollar amount of protection. So I think a lot of people have a misunderstanding, or where they're getting their information from, the person just doesn't fully understand all the laws, how it works in each state. So some states are more protected than others. So a lot of times people think or might hear that they're fully protected if they have a life insurance product, and that asset's completely protected because it's in a life insurance product.
so
But that's
that
not the case.
that is similar to homestead exemptions, if I'm correct, right? Because like California, we are in California, and our homestead is 100 grand. But if I look at Florida, their homestead is whatever the value of the property is or primary residence, right? So every state has different homestead.
Exactly, exactly. Works exactly the same. You just got to look up, depending on where your home base is, what state you live in. Just look up and find how much of your insurance policy is actually protected against lawsuits. Because every state it's going to vary by state. And then we also have a cheat sheet if anybody wants it. We can send
Okay.
that to them, and they can see exactly what's protected based upon what state you live in.
Got it. No, that would be great if you can share the cheat sheet with
Yeah,
the
for sure.
listeners. So another question I have is that you mentioned Nevada Trust. So it does not matter where I live, right? I can have the trust in Nevada, and that will fully protect everything I have in the life insurance product.
Correct. If you want to get in this strategy, you have to get in a Nevada trust. But the great thing is that you don't have to do anything. We actually do it all for you. We set up the
Okay.
trust, everything's done and structured. You just need to sign on it. So yes, it doesn't matter what state you live in. You don't have to live in Nevada. We do these all day long here in California, and we just put them in Nevada trust.
Got it. And I love the sound of leverage, right? So whenever I'm acquiring, and this is just for my listeners, whenever I'm acquiring a real estate property, I don't buy them on cash, right? My goal is to take advantage of the lower interest rate as well as using other people's money, which is in my case lender. So most of the time I'm putting down 25 to 30%, and the rest is carried by the lender or the bank. And same thing if I can apply to a life insurance, that that's like icing on the cake, right? Because you already
Abs-
have the
Yeah.
life insurance.
Yeah, absolutely. We use that analogy a lot when we're talking to people and explaining this strategy. because everybody's familiar with leveraging a home.
Yes.
Everybody also thinks it's the safest investment, which is, can be debatable depending on how you look at it. But people are just used to it. So what we're doing is just saying, okay, if leveraging a home makes sense to you and is a good idea and will grow over time, why don't you look at also leveraging your retirement? And and that's what we're showing people inside of this strategy is really how to leverage their money and grow their retirement, so they can have a more comfortable retirement and not have to cut down on their living and expenses when they get to that point.
So another question I have, because you mentioned 200 grand a year, I don't have that much. What's the minimum?
No, that was yes. Sorry, I'll be more clear. It wasn't 200. My example wasn't 200 grand a year. It was 200 grand over the 5 years.
Okay, got it.
Which is still
so 40 grand a year. Yes.
It's still a decent chunk of money, right?
Right.
So it's putting 40 grand a year over 5 years,
Yes.
which is 200,000. And it depends. Usually, the minimum's about 20,000.
Okay, that makes sense.
So because this is really designed towards kind of higher income earners. So you need to have that free cash flow, or at least have, maybe you have a bunch of money saved up in a checking account or CDs or money market. We can also use that as well. So, but yeah, I'd say about 20 grand a year.
Okay, so I'm still skeptical about this. What's the catch? Why does this strategy sound too good to be true?
Sounds too good to be true. Yeah. So we hear that a lot. We hear, is this too good to be true? How come I haven't heard about this before if it's so good? So there's a couple different reasons. One of the things I like to give an example of is, if you look at the mortgages, let's just take mortgages for an example. Since everyone can relate to them,
right?
Before 1934, prior to 1934, well, let me step back. At 1934 is when we created the Federal Housing Association, or FHA, right? Or FHA for short. Everybody knows it by FHA mainly these days. But prior to that, you would need to put 50% down on a mortgage, and you would have to pay that mortgage off in 5 years because there was a 5-year balloon at the end. So most people couldn't get a mortgage. Usually the only people that had mortgages back then were usually more of the wealthy people because they had the funds to be able to do it. And that's where FHA was created, and try to say, well, everybody should have the opportunity to be able to buy a home. And then that's when they created leveraging through FHA, and then kind of changed the whole lending institution as we know it today. So leverage financing inside of insurance products have historically only been available to the wealthy people. And the reason why is because you usually needed a $5 million net worth to even qualify for these. So that would, that eliminated most of America.
Right.
So, and leverage financing isn't something new in itself. It's been around since the 1960s. It's just been mainly only available to the wealthy individuals.
I see.
And what we've done here is structured this so that we can offer this to high income earners. So now the qualifications, instead of having a $5 million net worth, it's just going to be based upon income. So that's been able to open us up to offer this to, millions of people across America now qualify for this type of strategy.
Got it. So, go ahead. Sorry.
Oh yeah. Oh no. If you have a question.
So let's say someone puts down the minimum 20 grand a year for 5 years. That's 100 grand.
Yeah.
Hypothetically, for a 40-year-old, what kind of returns someone should expect? Right? Because we are talking about leveraging and then creating a 60 to 80, 100% more retirement income.
Yeah. So with the different illustrations we ran, because everything's based upon an illustration. Any investment is based upon projections looking outward, and there's no guarantee per se. But the IRR for what we're seeing for a 40-year-old, just depending on health as well, because health plays a factor into the cost of the insurance itself. We're seeing anywhere from, probably 7.5 IRR up to 10. I've seen them as high as 10% IRRs. So IRR, what I mean by IRR is internal rate of return.
Got it.
So that's what we're seeing inside of these policies that we're designing. And the main reason why is because the leverage that we're able to use. And that's why we're able to get such a high IRR.
I see. So, and what is the underlying insurance component? Is it a whole life insurance? Is it IUL, Index Universal Life?
Yeah. So this one, good question, by the way, because there's a lot of different options out there.
Right.
This one we specifically use a IUL or Index Universal Life, but you need to be able to structure these properly. If it's not structured properly, these plans will not work correctly. So you want to keep the cost down, you want to structure them properly, and you also have to understand financing and know how to structure financing properly for this type of strategy. And that's another reason why a lot of people just don't know about it or haven't heard about it, is because most advisors don't have the expertise in how to structure IULs the most efficient way. But not only that, they also don't have the expertise of how to use leverage inside of these products the appropriate way. So that's why a lot of people just haven't heard about it.
So, and I'm going to remind my listeners that go check out podcast number 83. On that podcast, we dug deep with Prashant and went through what is IUL, Index Universal Life Insurance. So I would highly recommend checking out that podcast before listening to this, because we don't want to go through, explaining what an IUL is.
Yes. Yeah. I mean, I've no problem explaining it, but yes, if people have an understanding of what it is, they will be able to see the power of how we're structuring this in a much better way.
So let's say, I can pay 40 grand or 50 grand this year, right? Yep. Next year as well. And then my income dips or something happens and I can't pay the annual contribution one of the year. What happens?
So good question as well. We actually get this one a lot because people are, are kind of worried about it. First I want to start off is that we always try our best for qualifying a candidate for this strategy to make sure we don't run into that situation. So if it's, if you're barely squeezing out 20,000 or 30,000 a year in savings, we don't want to put that full amount into the strategy in case because we don't want this scenario to come up. But let's say under your example, if you're putting in 40,000 a year and you do it for year 1 and year 2, and then you can't make year 3 payment. So if that can't be made, basically what's going to happen is that there's 2 things that will happen. First is that the lender will call your portion of the loan due, basically.
Okay.
So what happens is that they will go to the policy and they will take out what is owed to them from the cash value in the policy. And that's either done through a loan or a surrendering of the full value of the policy. So it just kind of depends. So that's one thing that could happen. The great thing is that how we structure these is that it has extremely high cash value, upwards of 80 to 95% in the first year. So if something goes wrong, the lender's fully covered and you're still getting some money back if you couldn't move forward. But let's say the second option is that we could take a withdrawal out of the cash value, pay the lender back. We could reduce some of the benefits in the policy, and then you can just keep paying into the policy and kind of try to get into a traditional Index Universal Life.
Okay.
And keep the policy in force and moving forward. You're just losing the leverage
component. Yeah. And that's the biggest part of this policy, though.
That's the biggest part. That's why we want to make sure that we are qualifying the people ahead of time so we run into that scenario.
And let's say someone is not disciplined enough to save it for the entire year, right? Because you just mentioned annually. Can someone pay this monthly?
So you for the first year, the first annual contribution must be paid in full.
Okay.
Now, since we're setting this up in a trust, one of the ways that we can help people manage cash flow, because a lot of people do manage cash flow on a monthly basis.
Right.
So first year premium needs to be paid in full. But from that point moving forward, if you want to break out the next year premium on a monthly basis, you can actually make those payments into the trust account, and then 30 days prior to the anniversary date, the trust account would then just pay the next year premium. Because
Okay.
so yes, the person can pay monthly. They'll just pay it into the trust account, and then the trust will just pay the premium at the end of the year.
Okay. Okay. So that is a way. Uh, and before the podcast, we were discussing about withdrawals, right? So, and you mentioned they are tax advantaged or tax favored. How does that work?
Yeah. So when you if people are not familiar with how to take money out of whole life or permanent insurance policies, either it's an IUL or a whole life or a GUL policy, there's two ways you can take money out. You can take money out as a withdrawal, or you can take money out as policy loans.
Loans. Yep.
Yeah. So, and then, I always go back to this analogy because people just understand it. If you get a loan either from a bank on a personal loan or even a loan for a mortgage, that money that's loaned to you, do you owe taxes on that?
Nope. Nope.
No, exactly. So we're using that same concept inside the policy, where you're just going to be doing policy loans, and the loan's going to be held inside the policy, so you never have to worry about paying tax on the loan on the money you're borrowing.
That's amazing. So, what I'm learning is that you should never withdraw money from your policy or should not cancel your policy. It's better
Correct.
to keep taking the loans out. So, and just to connect it to what you just mentioned from real estate perspective, like recently I'm doing a refinance of one of my investment property, and I'm going to get most of my money out. So I had put in, let's say, 100 grand, and
Yep.
now it's appreciated to 150 grand. I'm refinancing it, and I'm going to get 100 grand out. So I'll be free and clear. I mean, I won't have any money into it, and most of my money is back, but it's a refinance, so I'm not going to pay any tax on it.
Correct.
Right.
Yep.
So I can rinse and repeat now, invest in other place. So same thing as take the money out as policy loan, right? And you don't have to
Yep.
pay any tax, and you can keep investing or use it for your retirement.
Exactly. No, it's a great strategy, but you bring up a really good point when you first started, is that you don't want to take withdrawals, or even bigger, you don't want to lapse
Cancel.
policy.
Yes. Yeah. Lapse.
If you
Yeah.
lapse a policy, you could potentially have a huge tax bill coming your way.
Oh, really?
And yeah, because any gain beyond what they call the cost basis, or the amount you put in, any gain above and beyond that will be fully taxable to you.
Oh, wow. Okay. I didn't know that.
People need to be very, understanding how these policies work is just as important as
Got it.
funding it or anything else.
And so even this type of policy, do you also have to look at MEC, non-MEC?
You're talking about the modified endowment
Contract. Yep.
Yeah. So yes, MECing. MECing is what we like to call it. MEC is a MEC, a modified endowment contract.
Right.
Basically, what that is, in layman's terms, is if you end up MECing a policy, which means that you put in more money than that was allowed under the IRS guidelines, then they are saying, well, this is no longer a life insurance policy, it's an investment vehicle. So
Okay.
you take out from that will be taxable, even if you take a loan out.
Oh, even if you take a loan out.
Even if you take a loan out, because otherwise, So that's what's also another thing you need to be very aware of when you're funding these policies, make sure you're working with somebody who understands what they're doing. And
Exactly.
that it's structured properly. Otherwise, you can create a huge tax
Yes,
liability for
yes.
yourself, and you will not be happy.
No. So, and when will I be able to access the supplemental income in this policy, right? The policy via policy loan or whatever we call.
Yeah. So we usually structure these to be able to get access to them at age 65 is usually how we structure it. But um, you can't get access to the funds until the lender's paid off. So the lender gets paid off usually around year 15. So technically, you could get access to the funds in year 16.
Okay.
But we usually like to structure these to where, because we're usually structuring it for retirement and things like that. And so we usually like to wait until age 65. Obviously, if you are closer, if you're, I've done these on clients that are 60 years old, so they won't really be able to access it until 75 because they got to wait those 15 years. But it comes with additional benefits, living benefits as well. If you end up getting, a long-term care crisis, there's also some benefits in there inside the policy. So people can use it towards that prior to the 15th year if they ended up getting ill. But we also help structure this to where clients, if you did it as a 60-year-old, you wouldn't be able to access it until 75. We just plan your other assets to be withdrawn first, and then at age 75, okay, we start taking these, right? So it's also about planning once we get into retirement and things like that. So of where to take money and at what point.
Got it. And what happens to the policy if the return is less than the illustrated annual rate?
So very, very good question. One of the things I like best about the people I work with who help put this strategy together is they do a lot of stress testing. So, okay, the illustrated rate is exactly just that. It's just a hypothetical, right, illustration, right?
Yeah.
But the great thing that this company has done is they've worked with the insurance companies to kind of recreate worst case scenarios. But what I mean by worst case scenarios is that they've went and stress tested to see if this policy would survive the Great Depression scenario. So if we had a Great Depression again, where we had zeros for multiple years in a row, would this policy still perform over a 15-year period, be able to pay the lender back, and be able to provide income for the client? And the answer is yes on that. They've on all the different stress testing they've done, it's been able to still work if we hold it for that 15 years. And that's why that 15-year mark is very important. But they've also stress tested against another big financial, I don't know if you want to call it crisis or situation that we had, was the 1980s high interest rate environment.
Yes.
Because you're going to be borrowing money. So there's so the borrowing money cost goes up. So they've stress tested against that as well. And yes, it still worked to be able to pay the lender back and for the client to be able to receive income. Now, obviously, if those two situations, the income might be a little bit less than what we're illustrating, but it still works and provides some pretty good income for
I see. Clients. So I think this is amazing strategy. And the reason why I'm able to say that is because I already have a long-term care rider with my IUL. Okay, as well as I have a whole life insurance, right? So I have done enough research on the life insurance policies already. But what I actually like in this policy is the leverage component, because I'm able to increase my death benefit upfront, as well as the compounded interest. That's the word you use, right? So when I'm leveraging over the years, over 10, 15 years, 20 years, that compounded growth, it's going to, make my retirement easier, right? There'll be huge, retirement income coming after 65, 70, whatever, the strategy, however the strategy is designed for me.
Yeah, no, that's a great point. I mean, If you did this without strategy and you put the same 200,000 away for 5 years, then you have 200,000 on your side growing at compounded interest, right? Where if you do
Exactly.
this strategy, you have 800,000 of growing at compounded interest on your side. So when you do the math like that, you end up coming out far ahead by using leverage.
So, will there be a situation where if the loan can be called?
Um, yes, there could be. So I'm very happy to say that this scenario has never occurred.
Oh, wow.
So that's never happened. And I would say some of the reasons why that's never happened is because these lenders are fully secured through the cash value in the policy. So they really have almost no risk, which is really great. And that's why the loans usually are never called. But even if they, let's say one lender did call the loan, the group I work with, they have relationships with 10 to 15 of the top lenders throughout the world. So they can just move it to another lender if that's the case. And then absolute worst case scenario, if they couldn't move it to another lender, we could just pay the bank back with the cash value in the policy. And then that kind of goes back up to the two scenarios we talked about before, where if somebody couldn't keep paying into the policy, what would happen? Kind of follows those two examples. We just pay the lender back, and then we can close the policy down and take whatever's left in there, or we can just pay the lender back and then reduce the benefits down and keep paying into the policy on our own.
Got it. So the last question, that's good to know.
Yeah.
I always, whenever I'm looking at life insurance or any investment, there are always underlying risks. What are the risks?
Yeah. These are all great questions too. I mean, this is what people ask, and what's probably the biggest concern on their minds getting into this. So, one of the big things is that we're huge on education. So we want people to be fully educated on what they're getting into before they move forward.
Got it. So are there any underlying risks of this strategy? Have you seen, or when it was stress tested, or have you heard of anything?
Yeah. So the underlying risk is there's really two factors that can affect the policy, affect the performance of the strategy. So underperformance, which is just the market, and the high interest rates. So we kind of talked about this before. Both factors have been accounted by replicating those scenarios as we talked about in the stress testing, right? So we feel very confident that the two main risk factors is underperformance and high interest rates. To the way that we've stress test them, thousands of different scenarios, and that we feel very comfortable that this plan will still work and provide some good income for you in retirement.
Got it. So let's take a quick break, Steven, and after the break, we'll go to the fire round.
Okay.
Welcome back to Wealth Matters Podcast. I'm chatting with Steven Stanton about premium financing life insurance strategy, and now we are at the end of the podcast. So, Steven, welcome to Fire Round.
All right. Yes.
Would you be changing? Would you be changing any business or investment strategy after coronavirus?
So investment strategy, no, we won't be changing anything really on the investment side. We do full financial planning in our business, and our plans make sure our clients can weather storms like this. We also use great money managers that are able to limit a lot of the losses compared to the overall market. They did phenomenally well in the March time when the market tanked close to 30% or so. A lot of our money managers maybe went down 10 to maybe 18%. I think is the highest. Okay. So I think we have a good strategy on the investment side. As for the business side, personally on our business, yes, I think there's things we're going to be changing, because we usually did live events and gave live events in front of a group or or seminar type atmosphere. And this coronavirus that came out of nowhere obviously kind of smacked us on the head too.
Yes.
So we are definitely adapting to it and going to start adding a huge online presence to our business. So we can be more balanced as we move forward in case this situation like this ever comes up again.
That's awesome. Favorite real estate, finance, or any other related book?
So I would say right now, just what comes to my mind is a book that I'm actually listening to on a audio format, or Audible. I like to read, but it's easy just to pop it in and press play too. So, the book I'm listening to right now is Be Obsessed or Be Average by Grant.
Oh, yes.
I don't know if you're familiar with them.
Absolutely.
Yeah, I really enjoy that book because he touches on so many different parts of life in general in that book. I mean, it's personal, it's business, it's just getting out of your way and not letting negative people hold you back and things like that. So I really enjoy his teaching and his approach. I know some people might not like his approach. I mean, if you're familiar with him, either you kind of like him or you're like, maybe he's a little bit too
he's too salesy, he's a big marketer, but his books are good. So
no, he has really good teachings, but yes, he's always selling. So that's him. He's a sales guy who's built an empire, a gigantic $1 billion real estate portfolio. So he knows what he's doing.
Exactly. Yeah. How do you give back?
So how do we give back? So the way we've been giving back, I'd say a lot to the community is that prior to the coronavirus, we used to do 4-hour educational retirement classes at the community colleges for free.
Oh, nice.
It was done. We would do those classes through our private foundation. So it was a nonprofit private foundation. And we're strong believers, as I mentioned earlier on, in education.
Yes.
Even if you don't become our client, we love to educate people about financial services, what to look out for, and kind of what to avoid. And then also some of the things we do that we don't charge for any of our planning. So when people want to come meet with us, we don't charge hourly fees. But one of the things we do ask is that everybody bring 3 canned goods when they come into our office. And what we do on a monthly basis is then go and donate that. So it's a way that we and the clients can kind of chip in and do something good for the community, which we think is that program's been a great success. I mean, our front door fills up with tons of cans throughout the month, and then we just go and donate them. So
that's great. I'll be there soon then. I got to start donating.
Yeah.
No, that's awesome. So how can my listeners reach out to you?
So they can reach out. Would you like me to provide my contact information?
Yes, website, email address.
Yeah. So they can go to VerazAdvisors.com, and I know that's a little bit of an interesting name. So it's spelled VERAZ, then Advisors, ADVISORS.com. Then they can go there, check out the website. You can also email me at Steven@Veraz Advisors, and Steven's STEPHEN, or you can call me directly at 510-684-7381, which is my direct number. You can always reach me there.
That's awesome. Thank you so much, Stephen. Have a great day.
Yes, thank you.